Welcome back, everyone, to Q3 of 2022 PMA's Bulletin. I'm thrilled to be here with you. To all my PMA friends and associates, clients, and otherwise, we'll be sending out an actual printed documentation of Q3 with the various graphs in the next couple of days, and you'll receive that momentarily. Let me just give you the interpretation, is what I'll call it at the moment, of where we are and where the road ahead will take us. Well, the story of this last quarter is actually quite good news. I don't want to overplay this, but we've been very stable looking at the resale market for now 4 months. July, August, September, and October numbers just came out, and we've held at volume levels at 5,000 units a month for 4 months in a row. The delta's been modest, a little above, a little below, like 4,900 here in October. But fundamentally, one would look at this and say stability, stability, stability. This is critical for the long-term recovery of this market, with the battle against inflation being waged by the Bank of Canada. As you know, the interest rate policies now have gone up 6 times since spring, and this is unprecedented. We've gone from 0.25% to 3.75%, a 6-time change. The rapidity of the change had its impact. The impact was immediate. It was felt right off the top, and the resale market adjusted dramatically and quickly. Never seen it quite so swift as a change in price point, now hovering around the 19% mark as a downward average from February. Now, these markets tend to overcorrect slightly, so we may expect another 4 or 5% change over the next several months. But what you've had is actual, complete, and remarkable stability for the last 4. So when I look at price point, it's been hovering around that 1.1 million mark and has stayed there. 1,080,000 this past month in October, and it's been right within that delta for 4 months running. When I look at supply side, it was a little higher in the summer, but has eased back to around 13,000 units. Remember, a market imbalance here in the GTA is 25,000 units in that range on the market of listings at any one time. Currently hovering around this 13,000 mark is actually still very much a seller's market, a very tight supply of product available, and it has not gone up. It's stayed within this range within the last 3 months. And typically you would see a fall market that would rise a little bit and bump up a bit before declining in November and December and January. However, we've stayed at just about the same level. Now, people aren't going to move when they were a year ago at 2% 5-year money, and today at 6% 5-year money, plus a stress test of 2 points at 8%. I'm going to stay where I am. So the withdrawal of the consumer from the marketplace during this period is not unexpected. The withdrawal by the development industry from the market was not unexpected either. If you're not producing sales and you've got a huge backlog order with very difficult controlled pricing, then because of costs and labor issues, then it's natural that we pull back from this marketplace, build out what we have in terms of the new housing industry, and come back with a new program in the Q1, Q2 of 2023. Let me just touch on the engine behind this move, because you've seen rental rates soaring. Why did that happen? Well, a very tight supply, not a lot of new product coming to the market, high rise or low rise, in fact, almost non-existent. I think Urbanation points out that in this last quarter, on projects that are active within the marketplace, I think these, if I'm doing this quickly from memory, I'm sorry, but I think 96 projects out there that are active in the marketplace sold nothing in the quarter. There were no sales on existing projects, or very little recorded by Urbanation. New openings came to market, and we'll talk about that in a second. But let's talk about the push of immigration, and that's where we felt this power of the rental surge. When there's no supply and you've got the continuing flood of new immigrants into Canada, and a new record, 35% of that, 400,000 plus, ending up in the GTA, you've got a natural push on the rental supply marketplace. And rates, rental monthly rates, have just absolutely soared to the moon. This was also quite expected. Now, immigration is going to continue. In fact, announced just this November 4th is a policy by the federal government to increase this immigration over the next 3 years to 1.4 million. This will run at 460,000 a year to as high as 500,000 by 2025. I think there's an argument here that we might be going the opposite direction, that one might pull back on the immigration levels as we begin to try to catch up on supply. Because right now we're just overloading a system that can't deliver or won't deliver because of high rates and won't come to market. So you've got a kind of catch-22 going on. The bathtub's filling up and we're clogged at the other end. There's no supply and it's about to overflow. That's pushing up prices on the rental market. But it's a good news story. I mean, the immigration level is a good news story, and hopefully the change announced, we haven't seen the detail, but the change announced by the federal government at the same time is greater emphasis on the economic side of immigration. In other words, the capability of both economic stimulus as well as skilled trades. This has been a really serious problem with our point system in immigration, restricting and limiting the skilled trade applicant to come to the country when we need the most. I add to that, of course, the More New Homes Built Act, Bill 23, being brought forward by the province, and you've got an added stimulus of direction for greater supply. Suddenly, we're going to now move from maximum, I don't think we've ever done over 88,000 units in Ontario, to 150,000 a year over the next 10 years. Skilled trades, skilled trades, skilled trades. This is going to be a very serious issue as we move forward. Now, the feds have now just announced, just like today, that they're looking at this and going to make the changes necessary to bring greater skilled trades to the market. We've been lobbying on this for a long time, and finally being recognized. So that's good news. The underlying immigrant population moving to GTA is 140,000 a year. It's enormous. It's going to get bigger, putting more pressure on our very, very tight supply situation. The new homes market is slow to react. We can't. Fixed costs of labor and materials, fixed cost, of course, of a land component, one of the major components of a new house price and selling price, are fixed, are secured well in advance of a home being delivered. And so what you've got is a correction in the new house market in line with resale. It takes a long time. It ratchets down very, very slowly, and that's underway now. What you're going to see are new openings, and there's been a couple remarkable ones. Mattamy in Milton, Tridel in Mississauga on the high-rise side, RioCan, Marlin Springs coming in central Mississauga. Those two high-rise projects at $1,200 a foot when the market's generally at $1,400. A move by Mattamy for a single-family product at $1.1 million that a year ago in the fall of 2021 was about that price and soared up 200, almost 300,000 more through the spring. So these adjustments are taking place. New product, new price, new spec, new design details, which will cause a revolution really on the new house market, but it's going to take a while. You'll have a few early adapters like a Tridel or a Mattamy who will set the stage as they are now, and others will follow into the spring after the production levels have been met and satisfied. That will be part of the challenge going forward in the next Q1 and 2 of 2023 is, can I close all the stuff, all the product that we have under production? There's 96,000 condo units being under construction in the GTA right now, 96,000. Many of that, major portion are being delivered now and in the next 2 quarters. The challenge will be, can I close them now at what is really an OSFI market qualifying rate of 8%? That's going to be part of the challenge, and we're going to feel that a little bit. The other thing you're going to hear about is a trigger rate. This is something that a new expression that we hadn't experienced before, and it's driven by the impact of this rapid rise in rates, which passes over the payment made on the variable rate mortgage to individuals that have in fact set themselves at a monthly fixed rate, and the new interest rate moves past what that payment is each month, called the trigger point or trigger rate. What this will involve is then a renegotiation of the mortgage, a principal payment being made, or perhaps negative amortization, where your mortgage will actually rise upward as opposed to going the other way. Who'd ever thought? And in fact, though, what it will really mean probably is converting to more fixed term mortgages. The banks will have an issue on their hands. The trigger rate was hit really on the October 26th Bank of Canada rate at 3.75 for many variables, and there was a lot of variables, estimated as much as 50% of mortgages are variable rate through the pandemic. It'll hit the period of this kind of frothy period when we sold so much through 21 and 22, and how that is dealt with on as we move forward. So that'll be something to watch. I think it's a minor impact. It's not hugely significant. The banks will make every effort to try to make sure people can close and not only close, but make every effort on those on existing mortgages when it comes up for renewal or it hits those trigger rates. So we're going to manage our way through this. It'll take some creativity. In the terms of this rate movement itself, I must kind of laugh a little because suddenly we had a 50 basis point move, and around the office we all jumped for joy. How bizarre is that? But it was related, of course, to our expectation. Our expectation was a 75 basis point move, and it only went 50 basis points, and we rejoiced. I actually think it's a signal. I think it's a signal by the Bank of Canada, who are now saying they've had their foot on the throttle, pedal to the metal, and I'm going to ease off a little bit. We've done our job on housing, and real estate has actually corrected significantly. Does this mean that we might see on December the 7th at the next Bank of Canada announcement in another 6 weeks, maybe just a quarter point move to 4%? Bond yields would tell you right at the moment that we probably are topping out somewhere between 4.25 and 4.5 from Bank of Canada. That may occur in the first quarter of 2023 or even into the second quarter. But we might also find, as we are seeing this trend line of inflation pull back, so it's working. But it's yesterday's news, and what in fact has already occurred within the real estate market will be sort of the challenge we'll have going into Q1 and Q2 in 23. The market media response will be comparison year over year, and so the news is going to get bad. It's going to get pretty ugly. It's going to be a period over the next 6 months of a lot of media reports of, look at this, 18, 19, 25% deterioration in value. Well, it's old history. We'll have to remind the marketplace and the media to measure month to month and begin measuring the change of the stability that I mentioned right off the top, where prices have now leveled off and volume has appeared to have leveled off. This is all a great sign. And I think, in fact, the signal by the Bank of Canada, that 50 basis points, actually caused a little stir last week in movement in people out looking and buying and deals being done. Now, the consumer's looking for the best deal possible. That's a natural response to a market like this. What's my best deal? And so where that occurs, where a product comes to market and recognizes that the change or correction has occurred and is adjusted, product will sell. And it's remarkable that, in fact, we've hit 5,000 units a month on the resale market. Now, the new house side is different, and I've already mentioned that, but it's really flat. And it's going to continue flat until new introduction, new price, new product, new designs come forward. And that's upon us, and that's coming. But it'll ratchet down rather slowly, but it will have to. Now, new housing is always more money, as high-rise product, for example, on new is generally leads a pre-construction value, leads resale pricing, generally somewhere between 5 and 8%. The same is true on low-rise. It's about a 5 to 8% markup, if you like, of a new house price against resale. So it's not the same deterioration in value that we've seen generally. It'll be a little bit less, but it'll have to adjust to reach back to some volume predictions of steady pace. Now, one of the interesting things of this is pent-up demand. My goodness, in the 7 months that we've seen little action or deterioration of volume, particularly on new housing, But on resale, it's almost 20,000 units in 7 months that has not been fulfilled against a 10-year average. In the new housing market, it's almost similar, between 15 and 18,000 units that have not actually been absorbed in the last 7 months. Pent-up demand. Has immigration slowed? No. Has the propensity to move deteriorated? Yes. It's the psychology of loss. So the consumer looks at the psychology of loss and expectation and stays right where they are, looking for a signal. Part of the Bank of Canada's taking their foot off the accelerator was a signal. On December the 15th, write your member of Parliament, make every phone call possible, is the meeting between Department of Finance, Bank of Canada, and OSFI, the federal institution regulating the banking industry. They set the MQR, the mortgage qualifying rate, the 2% stress test. I think another signal is warranted. I believe that, in fact, the stress test is redundant, that it's piling on, that we're actually sitting at this moment with doing damage to the real estate, particularly new housing, when the province has announced this incredible new bill on attacking for the first time supply. And yet here we are piling on with OSFI adding on the 2 points when in fact rates should be stabilizing into the future. We won't see a continuing rise of rapidity of changes we've experienced in the last 6 or 7 months. So it's time for the stress test to be suspended, modified, taken away. Whatever, it'll be an important signal, and that mid-December would be an incredible time to do it as we try to adjust into the spring market. It would really help the housing industry without major loss of employment as we clear up the backlog of product we sold in 21 and now deliver that into the early parts of 23. We need to keep the engine moving. It's a big part of GDP. Okay, so there's some of that good news and some of what's happening. I think that we're probably on the road ahead is you're going to see this change of a significant product mix and form on the new housing market. We're probably back by Q2 on the resale scene, pushing back up over 7,000 units a month, moving to the 10-year average, which is about 8,500. That won't happen until Q2, but it's going to happen because stability has been so powerful. Supply, both in new and resale, continues to be really, really tight. The big concern would be pent-up demand surging with some kind of move, but I don't see that. I see it a very bumpy kind of stable market. The move of delta on price and volume is going to be very predictable month to month, well into the second quarter of 23. I can't overemphasize the new provincial program, this Bill 23 and Build New Houses Faster. This is a remarkable achievement on the part of the province. I know it's very biased coming from the industry like this and self-serving in a way, but we've been preaching the supply side mantra for many years, and it's been part of the issue since the growth plan was introduced in 2005 and just shrunk and shrunk and shrunk our ability to move product through the system and destroyed our approval process that was so significantly in holding back new product to the market. So now you've got supply at the top of the agenda. This is a remarkable change. It is an amazing document. If they can pull off even half the increase that they're looking for in the next several years, that in itself will be a major, major achievement. Toronto's 6.7 million people today, over 9 million in the GGH. This is a remarkable place to do business. It's in a fabulous marketplace to be part of the housing industry. The innovation and creativity of the part of this industry is legendary, and that'll start showing up dramatically within the next 6 months as we look at new product coming to market in the second quarter of 23. And really what I'm saying is that, hang in there, stay with it. We've got a bumpy road ahead of us, but we will manage our way through it as we have always done historically. And this amazing place called Toronto will actually flourish as we get later into 23. And of course, 24 and 25 are a brand new story as rates begin to come back again. So thank you for watching. I appreciate you listening in. Until next time, I'm Andy Brethour, Executive Chairman of PMA Brethour. We'll look forward to doing this again. And until next time, look forward and keep positive. Thank you very much.